Good afternoon and welcome to our first in a series of 10 webinars focused on affordable housing. My name is Rita Blevins and I'm your official moderator for today's program. As we continue this program from 2021, our annual theme is opening more doors in 2022. So each webinar that we will host will be geared towards educating the realtor community about programs, solutions, and opportunities for your clients in this ever-changing financial environment. Throughout the remainder of this year, we hope to provide information that will create more awareness and take away any stigmas associated with the idea of affordable housing. We are still finalizing the schedule for the remaining upcoming webinars, but all of them will be held from 12 to 1:30. You'll be able to register just like you did for this one on our education site or through har.com/webinars. And they'll continue to be free for all the members. Today's program is presented by Freddie Mac and is centered around economic trends, demographics, and business solutions for future home buyers. Before I introduce your speaker, I'd like to remind you to put your questions in the chat throughout the afternoon. You can choose for the questions to go to everyone or just the panelists. But we will field, or panelists, we will field all questions as time permits. If something's pressing, we'll pop in and answer them right away. If it's something that can be held to the end, we'll let you know that we're holding off, but we'll get to it. And I know that you're all going to ask. We are going to record this webinar as well as all our future webinars. And since you registered to attend, you will receive a recording. If you miss it, and you don't see the recording, it will be available on our HAR TV YouTube channel. But as a registrant, we always send the recording directly to you. So let's get started. We have an exceptional subject matter expert leading you through our program today. Carmen is a single family client and community engagement senior manager at Freddie Mac. She is responsible for building and managing industry relationships as part of the affordable lending team. She's committed to building awareness of Freddie Mac's offerings in alignment with the company's affordable lending and access to credit goals. Her team has trained over 16,000 real estate professionals throughout 2020. And my guess is that number has significantly increased through 2021, given that we were virtual and able to access so many members and realtors across the country, focusing on affordable products, resources, and tools to help existing homeowners and future home buyers during the COVID-19 crisis. Carmen started her career in real estate as a sales agent in 2002 and became a broker manager in 2006. So she definitely knows what you guys are going through. And she's held many leadership roles in the real estate industry. Amongst her many accomplishments, she was named 2011 president for the National Association of Hispanic Real Estate Professionals and launched the NAREP Leadership Academy under her term as president. It was featured by Housing Wire as one of the 25 most influential women in the housing economy. So thank you again for joining us today. And I'm going to go ahead and pass the platform over to Carmen. Again, we'll answer questions as we go and along the way, but Carmen, you've got the floor.
Well, thank you, Rita, and thank you for that introduction. I feel that I'm already part of HAR, so no need for the long introduction. I believe, Rita, I would say you're my friend at this point, and Teresa, because we've been working with you so closely. I will tell you, I continue to say that your entire leadership team has been, especially you and Teresa, so organized and phenomenal at bringing these things together that I'm just impressed that you can do all of this and schedule things so far in advance, which at Freddie, we completely appreciate. So thank you for inviting us today. Right. We have an hour and a half together. My goal is to be able to bring you some value. I was joking with Teresa and I was saying to Rita that I'm trying on my sea legs because I have been sitting for such a long time training and educating real estate professionals across the country, but now we're starting to kind of go out a little bit more in person, slowly but surely. So what I hope that today you get is value, not only kind of at the macro level, but really some resources and education on how you can take what you learned today and put it into your business and your practice every single day at a local level. Like Rita said, I entertain. I want this to be kind of a mutual exchange of information. So there is something that I say, I comment, I share, and you have a different perspective, or you just want to share something locally, please enter that into the chat. And Rita, please do not hesitate to stop me at any time to ask any questions that are pressing. If something really starts creating a lot of activity, I'm happy to go ahead and pause. I'm actually dialing in from Long Island, New York, so I will try to make sure I'm not speaking too quickly. But as Rita said, I have been in the industry for a very long time. I've joined Freddie Mac about 4 years ago, and my role within Freddie Mac specifically is really to reach out to the real estate professionals that are serving all buyers, especially those that are working with low to moderate income buyers across the country. The way we're going to kind of talk about today is going to give you some macroeconomics first, and then we'll go into some of the insights, products, and solutions. The first slide is, who's Freddie? What are we, and how do we help the housing ecosystem? Many of you may know Freddie Mac, generally speaking, as a government-sponsored entity or a GSE. We were actually formed by Congress in 1970, and it was very mission-driven. It was focused on really providing that liquidity and stability in the marketplace. And what you see is that really comes true in really difficult and hard economic times, more than even when the market is doing great. Because we take a look at how do we prevent foreclosure. So it's not only on the purchase side, is also stabilizing communities, stabilizing current homeowners so that they can stay in their homes. We also look at how we can expand credit affordably and responsibly. And we do that through a series of events, not only educating the real estate professionals, the lenders, as well as the consumers through some online virtual resources that are available. We have 3 different main sources of business within Freddie Mac. Single family, which is where I'm dialing in for, and that in Freddie Mac means anywhere between 1 to 4 unit properties. We also have a multifamily, and Freddie Mac, those are properties that are for rent that are 5+ units. And then we have a capital market segment within Freddie Mac. So today we're going to primarily focus on the single family, which is where I work within Freddie Mac. And we have 4 pillars that we focus on. Insights. You're going to get a lot of that today. That's kind of the macroeconomics, kind of the trends, what's happening. We look at data sources internally. We look at external data sources. And we have a phenomenal economist team, a research team, and they go ahead and provide all of this data in a really kind of consumable way so that those like myself and others from our team that are working at the front end of the business can go ahead and share that with you, industry professionals. And hopefully what you'll do is share some of this insight with your consumers or your future consumers. So let's take a look at these 4 pillars. The insights is kind of what we're doing today. It's the macro trends and the economics, information, forecasting that we'll share with you. Then the education is the actual outreach event that we do with the real estate associations such as HAR, as well as some consumer education through some of the housing counseling agencies, as well as self-paced consumer direct training. And I'll talk to you about that as well. And of course, we actually create guidelines and mortgage products that our lending partners can actually use when they're working with you and your buyers to secure that loan. We work in the conventional loan. We'll talk about some of them at a higher level, but welcome to come back and do a deep dive on any of them in the future. And then lastly, we'll focus on some business solutions, some shareable content that Freddie Mac has available, not only for you, but also for your past customers, as well as for your future customers. So let's take a look at some of those macroeconomic housing that our economists shared with us so that we can go ahead and kind of share this with you. You're seeing this at a local level. So although this is at a macro level, these are effects that are going to trickle down to the local market. And you feel free to share in the chat if you're seeing this, if you're not seeing this. We love that feedback. And we take that back up to our economists and say, well, this is kind of what I heard in Houston, and they like to receive that feedback. But what you're seeing is at the macroeconomic level, we know that the labor market continued to recover after COVID. And I use that word lightly after because I think we're still in it. But when you take a look at the impact that it had on unemployment rate, you saw that that was at about 3.9 in December in 2021. We have added the US overall a little bit under 200,000 jobs, but that still remains below what was expected. So when you also take a look at inflation, which we all are going through the pains of inflation, is putting additional pressures on really the consumer pricing, consumer behaviors. But you think that the inflation is going to start kind of really moderating off because this year, Federal Reserve begins to taper off its purchase of assets, is also looking at increasing interest rates. And you're already seeing that, right? You started to see some interest rates move up. On average, they expect that the forecast this year, they'll fall somewhere about 3.6. And in 2023 is 3.9. And although that is higher than we were, where it fell at one point just right below 3, some buyers may be saying, oh, well, maybe I shouldn't buy now. But the truth is, if you compare that to interest rates maybe in the 80s, I mean, it is still historically low. On the right-hand side, you'll see what you already know. So I don't really have to spend too much time on this. You know that the market is very strong. I hear this across the board, multiple offers, over asking price, really just not enough inventory for the housing needs, especially when we go and talk about the millennials entering the housing market that is going to put additional pressure to that housing affordability. But you're seeing this at a local level. So what do we think that could help is that interest rates are still low, even though they are forecasted to go up a little bit to 3.9 in 2023, again, historically low. In addition to that, you may have actually homeowners that purchased with you several years ago, and maybe their interest rate was above that 3.6 or even 3.9 next year, which is the forecast. I mean, we'll see how all lays out with inflation and what the Federal Reserve does. But if you take a look at this, you can actually reach out to past customers, and we'll talk about that in a few minutes. What I do want to point out here is that appreciation and total price growth, you see that they are forecasting that is going to taper down a little bit. Not negative, you see it's still appreciating at a roughly 6.2%. In 2023, about 2.5. So I want to pause you for a second because think about this for a minute. You may have homeowners that are kind of maybe ready to retire or ready to, step up and purchase the next property. And that 1 year difference of selling the house in 2022 or 2023 may make a big difference for them. So really understanding their financial needs, the needs, what is it that they want for the next home, whether it's move up or downsizing. These are really good conversations so that you can put things into perspective when you're reaching out to these particular current homeowners who may be leveraging the equity in their property. These are the home ownership rates overall. This shows you a kind of a nudged up a little bit across the US at 65.8. You see the highest home ownership rates in the Midwest, and this could be a lot attributed to kind of just the affordability in that particular market segment. So again, homeownership is still strong, but there's still a lack of inventory, and affordability is still really, really pressured. All of this that you already know. When you take a look at the equity though, I want you to take a look at this slide. So this is the slide I like to call it, using my realtor hat. This is a past customer slide. And what I mean by that is when you look at the outstanding debt on current mortgages versus the equity in the homes that currently exist across the country, homeowners are generally speaking in a really good position to leverage their equity in different ways. They can either leverage their equity and maybe reduce their interest rate if they are in a higher interest rate to refinance. They can reduce the terms of their loan. They can reduce the cost, the monthly cost. It depends on what they need. Or if they have a lot of equity, they may want to cash out and they may want to move into that next home or potentially buy a second home. So I always say this is a past customer slide where I would use the slide and reach out to my past customers, maybe offer a market analysis and let them know, did you know? Because consumers know the market is insane. Homeowners know that, but they may not know exactly what their particular home would be valued at. So I just wanted to stay on this slide for a second to make, to have you think about that for a moment. Have you reached out to your past customers? Have you had a conversation with them about their equity and their goals in life around real estate? It may not end up in an actual transaction for you if it's just a refinance, but it could potentially end up in a referral opportunity for you, which is going to lead me to the next slide. So this slide, I like to call it the referral slide. What I mean by that is when you take a look at the inbound states versus the outbound states, or vice versa. If I was a real estate agent, what this map is showing me is the migration to the Western and Southern states, right? And we saw that increase in 2020. And here, this slide shows you the kind of the trends and the different states that either increased or moved around in the inbound as well as the outbound. So if I was a real estate agent on the inbound states, I was going to reach out to those folks on the outbound states and say, if you have anyone who wants to move to my state, let me share with you some new developments. Let me share with you maybe some of the lifestyle or benefits, whether it's natural parks or beaches or whatever it is that they're looking for, and really start creating a marketing plan between you and the outbound and the inbound agent so that you're really networking with potential future homeowners that may be leaving one state and going to another. So I like to call this a referral slide, but this is just kind of a trend that you're seeing from 2018, and you see some of these states remain the same, and some of them kind of jumped around in terms of the order in which they were listed based on the research that we looked at. And then you also heard about what we call the urban exodus. Did everybody heard about that? I mean, it's been everywhere, a lot, especially in city centers. During the pandemic, a lot of folks said, everything is closed. I don't really have anything to do. I moved here because I wanted easy access to the restaurants or entertainment or whatever it is that attracted them to the urban market. But then when the pandemic hit, many of them said, I don't know. I want to go outdoors. I want to have more space. So you saw kind of that out migration from the urban neighborhoods into the suburbs. Some of them are regretting it. There's some research that talks about the regrets of some of those that did leave the urban markets to go to the suburbs. And now that things are opening up and they feel more comfortable, maybe they want to go back to what they were used to or what attracted them into that urban market. So pay attention to that, because you may have buyers that left to the suburbs recently who may be interested in selling that property sooner if they're able to, especially if they can still get some equity and actually purchase in the urban market. So just, just keep that in mind. When you take a look at, kind of the pandemic, I want to show you the trend. So on the left-hand side, you see 2018. This shows you based on how far did they move in mileage from where they currently lived when they actually made that move. In 2018, that was roughly about 6.5 miles away from their current home. That changed in 2020. This was about September. It went as like 8.5. What do you think that could be? I mean, some of the ideas that we think could be relocating just because, number one, they could work remotely. They didn't have to go to work in person every day, maybe just a few times a week for those jobs that still required some in-person visibility. But they were okay with driving further because they can maybe afford something better, bigger, or just a different neighborhood that they were or they would have not considered potentially in 2018. So just, take a look at that, because these folks, again, made those decisions around remote working, or if they do regret having moved for any reason, now they're going back to the office more often, they may be looking at potentially selling their properties a little earlier than maybe they even themselves anticipated. So just, food for thought. Feel free to chat, and Rita, feel free to stop me at any time. So now we're going to kind of shift a little bit and talk about some of the challenges to homeownership when it came to first-time home buyers. So we looked at findings from the Urban Institute and the National Association of Realtors, or the two reports that were pulled for this particular slide. And what you're seeing is that the research shows that consumers actually identify 6 areas in their household that they felt that were really giving them a difficult time to save for that down payment. If you look at the bottom, on the gray mark on the screen, you'll see that 50% said that student loans was exactly what was holding them back from actually saving enough for a down payment. And then credit card was number 2, and car loans was number 3. But now I'm going to take your eyes back up to the left side of the screen, and you see that all buyers across felt that saving for a down payment was the most difficult step in the buying process. And when you look at the millennials, actually those that were 28 years or younger, so those are your younger millennials, 26% of the respondents said down payment was the most difficult thing for them to save up. Older millennials, a little lower at 24%. But look at the green over here. The borrower's lack of general knowledge about down payment, period. 40% did not know what was required. How many of you in your offices have, maybe buyers go in, what does this process look like? They haven't met with the lender. They may not really understand how much of a down payment they are required to give. I know we're in a crazy market, so I don't want to understate that. I know that right now, the more down payments, of course, it's going to most likely be more attractive to a seller. But Rita, you said it is opening one door at a time. We have to give opportunities to these first-time home buyers. And some sellers really do want to give the opportunity for that first-time home buyer. And they're not less qualified. They're going through the process. A lot of these first-time home buyer programs require home buyer education. They actually have worked really hard at saving for that down payment. 42% did not know that there were even low down payment programs available. So a lot of them are defaulting to saying, well, the mortgage calculator on XYZ website says 20%. It defaults to that. So you can understand, right? I mean, it's easy for that buyer who's not well versed in the market to think that that's actually a reality. Again, I'm not saying that we're seeing higher down payments because of the market that we're in, but what is required is different than maybe what is actually happening at the time. So that's where you come into play to be able to reach out and make sure that we are taking that myth away. You do not need 20%. You can actually purchase with a conventional loan with as little as 3%, and in some cases, even less of your cash out dollars. So let's go ahead and take a look. So this is from NAR. So I love NAR studies. We pull them a lot, especially when we're working with the real estate community. If you don't download it every year, I do. I recommend you do. There's just so much information that NAR pulls around buyers, trends, and a lot of that is coming from your transaction and surveys that they actually put out there to the community. But this particular slide, what I want to point out is 3 things only. One of them is married couples continue to be the highest number of all buyers, especially first-time home buyers. But second is single females. So I want you to rethink about that for a second. What are you doing, if anything, to make sure that you are networking in a place that is going to attract? Where do single females, where are they going for their information? What are their what type of things are they reading, listening to? Where are they networking? How can you make sure that you are providing information about purchasing a home as a single female in your particular neighborhood? The other thing I wanted to point out is the first-time home buyers that were 29 years or younger. So you have millennials, you have your older millennials that are 30 and older, and then you have your younger millennials that are 29 or younger. 88% of first-time home buyers were 29 years or younger. So I want you to take a same approach. What can we do to make sure that the information that you're sharing with your future home buyers that fall within these growing markets are actually getting your information, that you're really mimicking where they're looking for their information and reaching out to them? And then if you remember the barriers that we shared a few slides ago, what are you doing, or what can you provide to make sure that you're helping them understand that this is a process, or that you can help them with the process, even with a general knowledge of first-time down payment programs that may be available at a local level, or just low down payment conventional products that are available. Or if they're a veteran, then maybe they know they can purchase with 0% down. So all of these things, I know that as a real estate agent myself, when I was selling, I didn't expect to know the ins and outs and the qualification and guidelines and all of the details around the products, but I did feel responsible for knowing a basic knowledge so that when I spoke with a potential buyer, before they even worked with their lender, that I was privy to kind of some of the options that they had available. I felt responsible, and I felt proud of knowing a little bit about it. Again, I was not an expert. I was not an originator. but I did try to make sure that I sat down with my lenders in my market to understand, did they have a portfolio product? What were they offering? Sometimes they have products that no one is really aware of. So unless you ask, sometimes you just don't know. So try to set up those meetings with your lenders, have a conversation, and let them go through it. The best time to learn about a product is not when you're in a transaction. The best time to learn about a product is before you're in a transaction, because then you can hopefully overcome any hiccups along the way. When you're in a transaction, it gets chaotic, right? You're trying to get everything done. You're working with multiple buyers. So buyers are anxious, and rightfully so. So that's where you play a role. Moving along and keeping kind of with the theme of the younger millennials, this was also from the actually National Association of Realtors Homebuyer and Sellers Generational Trends Report. And what you're seeing here is that 31% of all buyers were actually first-time home buyers. So they play a really big role in the purchase market. And when you look at the 86% of the younger millennials that were first-time home buyers, again, those are those kind of 29 years or younger that are entering the market. And when we compare this slide to the Freddie Mac data, which shows us from the millennial loans on the purchase side, not on the refi side, you're looking at the homeownership trends, you see that in 2009, that was roughly 33%. But now in 2020, that really, peaked to 49%. So they are really a driving force in the home buyer process, which again, I know I'm preaching to the choir, but this is a trend that we're seeing across the country. When you compare that to Freddie Mac, these are mortgages that we purchase from the lender. So like I said, we don't lend directly. We create the guidelines, we have mortgage products, the lenders use our products, they secure the loan for your buyer, then they sell those products to Freddie Mac, those loans back. We go ahead and go out to the secondary market, we securitize them, we find investors so that we can provide liquidity back into the market, so that lenders can go ahead and continue to lend, whether it's a 15-year loan or a 30-year loan, to your buyers. So this is kind of a snapshot of the mortgages that we purchased in 2020 and those that were actually issued to a millennial buyer. And these are loans that were acquired by Freddie Mac. If you look in 2009, that was at 14.1%. In 2020, that was 51.9%. That's a huge jump. Several reasons. Number one, you have those younger millennials that we talked about. Those are starting also to enter into that buying stage. So they're not as young as we thought they were anymore. And some of them are already making decisions on purchasing the property. And the next slide is actually going to show you that although married couples continue to be the strongest, kind of buyer out there, single females or single males and unmarried couples also play a role. So what decisions are millennials making? Some are buying a house before they get married, and that's what you're going to see on the next screen. So what you're seeing here on the left-hand side, you see all buyers. You see that married couples, which is the darker blue, continues across all generations, continues to be the highest kind of driver for making the decision about purchasing a property. But I want you to take a look at a little bit what I like to call a little bit of the outlier here. When you look at 22 to 29, you see that light blue, these are unmarried couples. So maybe they're not making the decision to get married first, they're moving in with each other, they're purchasing a property together, and then they get married. So again, it's the timing of when do you reach that first-time home buyer. It may be a little different than what we thought before. So this is just generationally. It shows you that generation trends change. If you look at 74 to 94, that unmarried couple was 3% compared to 21% between 22 and 29. So times have changed. The other thing that to look at here is that buyers that were 65 to 73 were the age group that had the highest share of single females. So this could be retirees, it could be widowers, unmarried, never married, divorced, and everything in between that are making decisions to purchase a property. And 22% of them are least likely to actually have any children under the 18 living in their homes. So maybe the types of homes that they're looking for are different. Maybe it's a 55 and older community, maybe not. It all depends on their preferences. But again, this is just kind of high level macroeconomics. Is this mimicking your market? I don't know. You can tell me, right? Are you seeing kind of some of these trends take place in your own local market? You tend to see that national trends trickle down differently depending on the market that you're in. So what does this mean to you? The purchase market is still strong. I know that you know that. You've been most likely busier than ever. Qualified first-time home buyers, though. I love what Rita said again, opening one door at a time. They do need your help, not only for the pre-purchase education, but during the whole process, and sometimes way before they're even mortgage ready. So we need to take a look at how can we all together play a role to start, moving the needle. I don't want to lose sight. I get it. Inventory is an issue. Appreciation is great for current homeowners, not so great for those buyers that are looking to purchase a property. They're getting outbid, but things will change. Real estate is cyclical. So let's make sure that we're nurturing that pipeline so that those opportunities, even if it's one at a time, we can actually get more of these first-time home buyers into an actual home. So what I want to also share with you is when you look at the millennial cohort, not only are they such a growing market, they are one of the most, if not the most diverse community within all of the generations. So that's really interesting because you're going to have a lot of diversity in race and ethnicity as well. So let's take a look at mortgage ready and what does this mean? And I want to kind of give you a definition of what Freddie Mac means under mortgage ready. So we did I do have to have a disclaimer on this. With mortgage ready, this is based on research. This is not 100% following the guidelines or the underwriting criteria, because we know that a lot more goes into financing or making a decision on qualifying someone for a loan. But for research purposes, we said, well, let's look at some of the criteria that are used for qualifying a loan. Credit score, foreclosures, bankruptcies, right? Kind of looking at their debt to income ratios. So you see there's three categories, and we're going to show you how this varies generationally. Mortgage ready on the left-hand side are those that have a good, strong credit score, 661 or better, debt to income ratio 25% or less. And if you can see underneath, no foreclosures, bankruptcies, delinquencies. When you look at the near mortgage ready, 45-year or younger, do not currently own a home, but do have a debt to income ratio 25% or less. Their credit score or their ranking may be a little lower, maybe under 661, but same thing, no foreclosures, bankruptcies, or delinquencies. And then you have the not currently mortgage ready. These are going to be under 600 FICO scores or credit scores, debt to income ratio 25% or less. There's Vantage scores, there's FICO scores, so those all of those vary a little differently. But they do have maybe a foreclosure, or maybe they have a bankruptcy, or maybe severe delinquencies. So those are going to be longer term investments in terms of educating them and getting them to near mortgage ready or to mortgage ready. So now what we're going to take a look at is in the mortgage ready or near mortgage ready by generation. So you'll see that 41.1 million overall total population is in the category of mortgage ready. That means good business for you, right? That's a lot of opportunities. Yes, I know it's nationwide, but again, it's working with those outbound, inbound migration to say, why should I move to Houston? Why should I go there? Sell me on going to Houston, right? Work with a real estate agent that's not in Houston so that they can really help you kind of really create that referral business. But when you take a look at the near mortgage ready, these are individuals that are really close, maybe with a little bit of, home buyer education, financial literacy education, maybe bringing down their debts a little bit, paying off, maybe to a third of their credit card, bringing those balances down. They could be that close to actually becoming mortgage ready. So you see the generations, different. You have the Gen Z mortgage ready is 55% at 7.1 million. When you take a look at younger millennials, you have 43%, so that's 12.8 million that are actually mortgage ready. And you look at older millennials, 31%, 14.4, and then you look at Gen Xers, 26%, 6.7. So again, the growth is right here, right in the middle. Older millennials, younger millennials, Gen Z, that's where the opportunities lie. And what are you going to do, or what can you do to really reach out and educate this particular cohort? Now, what you're seeing here, this one is really interesting. You see that the highest share mortgage ready, what it's telling you on the left-hand side, you see Gen Z, younger millennials, older millennials, and then you have over here, the auto loans. The blue plays a big role. So it's not only student debt, which is the kind of the orangey color right here. Student debt for Gen Z is lower than it is on the auto loan. So this could be that they're just starting college, but they already have the car. So again, conversation about priorities may be a good conversation to have with this group. Younger millennials, again, you have the auto loans pretty high, and then you also have the student debt following second, and you see how that changes with the different generations. The older millennials, you know, they've been working longer, they've been able to save a little bit more. Now with the CARES Act, some of them may have even paid down their student debt further, because even though they could have put it on forbearance or on hold, some of them kept on making their payments if they weren't impacted financially because of COVID. So actually this will be interesting to see how this turns around once we get the new data in, because you may see that older millennials and younger millennials have made maybe a larger dent on their student loans. So this will be interesting to see. But also understanding what kind of products are out there and how student debt is calculated is very different depending on the product. So a favorable calculation can help that particular buyer maybe purchase a little bit more of a property or maybe reduce their costs overall. So let's go ahead and take a look at time to save. So this is the one that I say it's either disheartening or aspiring. Depends on which column you look at. If I knew that it was going to take me 20.3 years to save for a 20% down payment, then this slide is like I like to call it, disheartening. If I take a look and say, oh, but it would only take me 3 years to save for a 3% down payment, this is going to get me more excited. So this just shows you based on their income, their monthly income, the median house price that the millennials are purchasing, and how long it would take for them to save. So this is where I, again, really default to so many mortgage calculators, default to 20%. And I think we're doing ourselves a disservice because we're losing out or disheartening maybe potential home buyers who don't understand. We looked at another slide before, it showed 40 to 42% didn't really know what the down payment requirements were. So those mortgage calculators defaulting to 20% is not helping the case. This also shows you across the country, the coastal cities, generally speaking, have the highest share of mortgage ready, but affordability is threatened. So it's hindsight, right? I can make more money maybe if I live in a coastal city in an urban market, but at the same time, it's going to cost me a lot more to live there. So again, it goes back to that outbound, inbound, and if you remember the slide before where it showed how many miles away people are willing to move now that people are in a more remote environment, went from 6.5 to over 8.5 miles. So looking at this map could change over time. And again, this is where you can play a role on saying, what's available maybe another 2-3 miles away that maybe buyers weren't interested before. Their appetite may be different these days with remote working. This shows you the thin credit files, 14% that are not currently mortgage ready. That means that they're going to need a lot of time to really learn about credit usage, using it in a positive way, not in a negative way, healthy way. Again, managing their finances, understanding their credit risk, so that when they are evaluated for a purchase, that they understand what is weighing in those decisions. So this is where education, and we'll talk to you in a little bit about that, is going to play a big role. So I'm going to go ahead and move forward. So before I move ahead, Rita, I want to just do a check with you to see if you have any questions or anything before I go into the product.
I haven't seen any questions come through, but if anybody does, feel free to put it in the chat. But you're pretty comprehensive. You're doing a great job. So I think that people are just listening in. I think some of the questions might be, looking at any statistics that you might have for 2021 and when those might be available.
Well, that's a great question. And I'm going to share, there's a research, we have a FreddieMac.com. You go there, you can find research and forecast indexes. They update it usually quarterly. And then anything that is going to be reported on an annual basis, normally it's a year lagging, right? Because they have to close the year, then do all the analytics and all the numbers. So that's why you'll always see most high level national kind of trends lag a little bit, unless they're looking at a specific quarter. But yes, you can find, and we'll tell you where you can find a lot of the research that we're sharing online. It is publicly available on our Freddie Mac website.
Awesome.
So now let's start shifting. I'm actually, hopefully this slide doesn't move before I ask the question, but I would love to ask this one. If I had to go to you as a real estate agent, I went to you and said, Rita, I'm not asking you, Rita, I'm asking everybody else attending. I need a low down payment loan, 3%. I heard there's something like that. What are the loans that come to mind? Just from your experience. Put it in the chat. I'm looking down here because I'm actually looking. FHA, it's usually the first one people think about. Anything else? FHA, yep. Oh, I got a conventional. Thank you, Edwin, for that. Appreciate that. Okay, good. Excellent, thank you. It's so much nicer when you can interact with people. If we were in person, I could see you, but physically there. But okay, so here's the reality is that there are many programs out there that are available. FHA is always one. As a realtor, that's what I would think of, honestly, myself, outside of VA. And it's not, because actually FHA requires 3.5%. So when I use the trick question of 3%, FHA shouldn't come up because it is actually 3.5%. Where a conventional product like Home Possible, and again, there are other products out there, but this is the Freddie Mac, what we call our low to moderate income purchase. This is for low to moderate income buyers, is 3% now. And it actually can be layered financing. So they can layer this with a second loan that's a grant, as long as they take second lien on that. So sometimes they have a down payment assistance. It goes kind of as a second lien, or they can have a local grant and they can also bring that down. So Home Possible is the Freddie Mac 3% conventional loan. So this, we're going to talk about this at a kind of a high level. Again, we can always come back and dive deeper. But with the Freddie Mac loan, the Home Possible specifically is for individuals that are making 80% or less of the area median income. I'll repeat that because it's going to make sense in a little bit why I repeat it. 80% or less of the area median income. So we'll show you where you can find that area median income. You can be as specific to the actual physical address of that one property. But we'll show you where to find that in a minute. As I mentioned, if they have second financing, whether it's maybe a grant, a down payment assistance program, they can go as high as 105% of the total loan to value, as long as that second grant or financing takes a second lien. We do look at flexible sources of funds, so they actually can use the down payment program as well as gifts from family members who maybe it's mom, dad, grandma, grandpa, whomever, that they are actually be able to show that they're getting that gift from that particular person. Your lender will work to make sure that they get the proper documentation. The thing that I find really interesting is also that people sometimes forget that with the FHA, there's an upfront MI premium. With Home Possible, you don't have that upfront fee. So what does that mean? That can save me money. That upfront fee, if you're working with a low to moderate income buyer, most likely they're going to finance that upfront fee into the loan. So they're really paying that fee plus 30 years plus the interest rate, right? It's costly and it's not removable. It stays for the life of the loan. Where with Home Possible, as a conventional loan, once they have 20% equity, they actually can have that mortgage insurance removed as well. So those are some of the differences between FHA and a home possible loan. There's no minimum borrow contribution. So if they are receiving, money from gifts or from grants, sometimes that 3% could be even a little lower. We do look at non-traditional credit. We'll talk about that in a little bit. And really, it could also be used not only to purchase their first home, it could actually be used if they're buying the second home. So it's not only for first-time home buyers. They also can use Home Possible to refinance if they're looking for a no cash out refinance. Here's the loan to value ratios. We kind of talked about that, but what I didn't mention is that you can actually purchase a 2 to 4 unit property as long as you give 5% down with a home possible loan. So 3% down for 1 unit, 5% down for the 2 to 4 unit. And then you can also purchase a co-op, a condo. You can purchase a 1 to 4 unit property, detached or attached. It's owner occupied only, primary residence, but they can. This is a little newer, so always ask your lenders if they're aware of this update, that non-occupying borrowers are actually permitted on the loan. That wasn't the case about a year and a half ago or so, but that has changed. So just make sure that when you're speaking to your lender, that they are also aware of that. I'm sure they are, but it's never bad to ask. So this is a good, I like this slide because what it tells me is that some individuals may be looking at a mother-daughter situation, and maybe a 2 unit is more affordable for them, even with the higher down payment, because the slightly higher down payment is still very low in comparison. So it may make it more affordable. I have a perfect example of this. My son just purchased his first co-op, and he's 24 years old, and he used the down payment assistance program in order to do that. But he realized that rentals, I don't know how they are in Houston, but on Long Island, it is very expensive. A 1-bedroom apartment, sometimes in a house and not even in a building, can cost upward of $1,600, not including utilities. Sometimes it's $1,800. There are some more luxury rentals that millennials are just honestly thinking that they're back in college and getting a roommate because the rents are $3,100 for a 2-bedroom. So it's very pricey. So really looking at these affordable options really are key, opening that door for these, especially the younger buyers. Here's a side-by-side comparison. I kind of talked about it. This is just a cheat sheet, like I like to call it. And again, you'll have access to this. It just shows you the differences between FHA and a home possible mortgage. Again, that upfront MI premium and the fact that you can cancel it, plus it's 0.5% less down payment, it could be a game changer for a lot of your borrowers. So again, FHA is not a bad loan. If you have somebody with really, really low FICO scores, maybe that's the name of the game. If you have a VA, a veteran, the VA may be the best option for them as long as they still have their entitlement. But it's good to know about all these options, especially on the refinance as well. So this was the question I asked, I said, you may ask yourself, how do I know what the 80% of the area median income is? Actually, we do have a home possible income eligibility tool, and that's what you're seeing here on the site. So if you go to this website, you're going to be able to enter an actual property address right here in this little white box. I know it's a little small on the screen, but when you're on the website, it'll be way more visible. When you enter the address, what it's going to do is going to tell you what the income eligibility is for home possible. It's going to tell you that would be the 80%. And it's also going to give you a link that you can click on, and it'll show you down payment resource programs that are available federally, locally, and nationally. So it's great to put the actual address if you have it, because then it'll tell you what's available. So take a look at this website. If you do nothing else, I do encourage you to do that. I'm sorry, I'm looking at.
Yeah, did you see Diane Moore had a question about non-warrantable play, about a condo? Does non-warrantable play a role into approval?
Wait, can you repeat that again? I'm sorry, Rita, I didn't get that.
She said, oops, sorry. You mentioned a condo. Does non-warrantable play a role into approval?
When you mean, I want to make sure I clarify the question. You mean non-warrantable in the sense of whether that condo is approved for financing? I'll need that clarification before I can answer.
She said yes.
Okay, yeah. So usually for Freddie Mac, if it's FHA approved, then they'll be able to secure it with Home Possible. If it's not, the lender does have a way to submit the actual condo to see if it would be approved. So, again, don't call it out. Don't assume that no, just have your lender check, because your lender will be able to check, can they finance in that condo using Home Possible condo unit or premises or not? So I always tell people, always ask, and don't assume it's a no, even though maybe another condo was a no, because that particular, whether it was reserves or anything that didn't qualify that particular condo, doesn't mean it's going to be the case. But generally speaking, if it's FHA approved, it's financeable through Home Possible.
Okay, and then just to reiterate, we're going to send these slides and the links that you've mentioned after you are done today, and we'll send it with the recording. I know there were some folks that were asking for those links. And then someone asked, has the MI for the life of the loan on FHA has been all the time, or is this new? Oh, I'm sorry. No, it's always been that, right? It's always been that way.
It's always been. I mean, if on an FHA, if they believe, if they're giving, and definitely I would tell you to go to the FHA guidelines, because we don't work for FHA, so I don't know if they've changed anything recently. But usually, if they're giving more than that 20% down, which would defeat the purpose of using an FHA, then they cannot have to have the MI, but that upfront fee is something that they will have to pay regardless. So at minimum, you're saving that upfront fee. And usually individuals using an FHA historically are not giving 20+% down, right? They're using it because they are looking for that low down payment option. At one point, Rita, though, years ago, I do remember that it was cancelable, but that is not the case, again, unless they're having a really large down payment.
Yeah, I think it was, well, I mean, they can always refinance, right? If once they get equity.
Oh, yeah, no. So thank you for saying that. So correct. So you may have buyers that you helped purchase with an FHA. I think I saw somebody put, they helped somebody in a condo with an FHA. It was difficult, but they got it approved. So just keep track. That buyer may be able to, down the line, maybe they were working on their credit. I obviously don't know the nuances about that particular buyer, but if they get better credit, they start maybe having a better credit indicator. All of these things they can refinance, absolutely, Rita, and they can say, well, let me look at Home Possible as a no cash out refinance option, just to even eliminate the MI. So thank you for mentioning that. That is a great way also to use Home Possible as a conventional loan. So just keeping track of some of the chat here. Okay, yeah. So it was maybe several years ago in terms of when they changed that. It was a while ago, but at one point, yes, it was removable. But now it's not, unless they're giving that larger down payment. Okay, so now you may ask yourself, Home Possible, remember, I said I was going to ask you this, and I said it twice purposely. In a few seconds, I'm going to do a little check-in and a quiz. But Home Possible is a low down payment option, 3% down, Freddie Mac conventional loan, and the buyer has to be at what percent of the median income? Enter it into the chat. Whoop, let me not give you the cheat sheet yet. Okay. Very good. Everybody was paying attention. Thank you. Correct. 80% or less of the area median income. But you may have buyers that make above that median income, but still are either in need of a low down payment option, or maybe, buyers are making different decisions. They may, with the whole pandemic, a lot of people want to keep some assets liquid and not tie it all into the home. So maybe they have a little bit more than that 3%, but they want to keep it, somewhere safe, because They don't know what could happen. Nobody expected that people would lose so many jobs or income reductions or any of this that happened. No one, the whole entire world didn't know that. So you have some people that are higher income earners, but are playing it safe when it comes to buying that property. They don't want to put all the eggs in one basket. They want to have liquidity. So Home One will serve those buyers. It's going to sound and look a lot alike Home Possible. One of the differences that it is no income limitations. They can make as much money as they want. They can give as little as 3% down payment, and it is a conventional product. There are some slight differences, which I'll share with you on the next screen. One buyer at minimum has to be a first-time home buyer. It is only for a 1-unit residence. It does not include manufactured housing. Where with Home Possible, you can actually do manufactured housing, co-ops, condos, single family 2 to 4. Here, it's only 1 and no manufactured homes. All borrowers, though, must occupy the residence. So if you remember, on Home Possible, a non-occupying borrower could be on the actual loan. With Home Possible, all borrowers must occupy it as their primary residence. So that's one of the differences. So true or false? If there are multiple borrowers on a loan and one borrower meets the definition of a first-time home buyer, can they borrow and currently own another property? Is this allowed? Yes or no? Look at some of the answers here. Oops, there we go. The answer is yes. So they actually can, they have to be a first-time home buyer, 3 years not being on a deed. That's the definition of a first-time home buyer. But if the borrower currently owns another property, they can actually purchase one more with Home Possible. So it's not completely out of the question. So they can have a second property, they cannot have more than 2. Do I have to meet the area median income requirements for Home One? Yes or no? Looking down so I can see the chat. Remember, for Home One, okay, so there's a mixed bag. Okay, a lot more no's coming in now. Let's see the answer. No, not for Home One. And that's where I said I was gonna do a little cheat sheet. Home One is no income limitation, Home Possible, 80% or less. Okay, so this is a side-by-side. I'm not going to spend time on this slide. We've covered pretty much everything on the other slide about Home Possible versus Home One. So this is just a cheat sheet. Again, like Rita said, you're going to get a copy, and this session is being recorded as well. So now let's go into the latter part of our presentation. I just have a few slides, and this is really for resources. So if you have consumers, buyers, future buyers, maybe you're just on your social media trying to kind of cast a wide net and have potential buyers reach out to you for their real estate needs. But you don't know who they are, you don't know what they need. You can actually copy this link, put it on your social media feed, myhome.freddiemac.com, and this is a website that's consumer specific. There's resources for buying, for renting, for current homeowners. There's COVID-19 support for renters if the property building they're in is owned by Freddie Mac. So this is a great resource, and this is consumer facing. It is also available in multiple languages. You have a lot of borrowers that really don't even understand the mortgage process. We talked about that in the first couple of slides. So Freddie Mac actually in the My Home website has a step-by-step mortgage guide that can help the buyers understand the mortgage process. And it is also available in multiple languages. Give me a second. I'm going to take a sip of my water. I learned, don't fight it. The sip is better than a cough attack. So here's Credit Smart. How many of you have heard of Credit Smart? Look at the chat. Okay, thank you. Nope, okay, great. Credit Smart is it's not a home buyer education. It's actually a financial literacy curriculum. We celebrated 20 years this past year, and it was revamped completely. But this is a great tool. I would say if you have kids that are in high school, maybe middle school, college, send them to this website. It talks about understanding financing. It goes into auto, it goes into renting, into purchasing, credit scores, etc. So I strongly recommend that you go to Credit Smart and you download it, click on it, entertain yourself, go through some of the actual different courses. Excuse me, I fought the cough that is coming anyway. And it's available in multiple languages. So this is a financial literacy course, no cost at all, that is consumer facing. This is kind of what you're going to see in the Credit Smart Path to Education. There's a goal setting piece of it. There's how to earn, how to spend your money smart, how to become a savvy buyer. Excuse me. It even gives you plans to save, how to prepare for a project if you are a current homeowner. This is what we call our Credit Smart Essentials. This one here is home buyer education. So for Home Possible, Home One, and most any first-time home buyer program, there is going to be a home buyer education requirement. Freddie Mac launched this several years ago. It is free. They can go ahead, go to Credit Smart Homebuyer U. So that's the difference. This one will actually satisfy their educational component for a lot of these first-time homebuyer programs. They can go in there, take the course. There's 6 learning modules. When they complete the course, what it's going to do is going to send a certificate of completion to satisfy that mortgage requirement, and they can email it right from the website to their lender. In addition to that, they can email the certificate of completion to their real estate agent, because what this does, it keeps you both in the know as to where they are in the entire process. So Homebuyer U is available currently in English and Spanish. It has been optimized so they can use it mobily on their mobile phone, on the go. So I recommend that if you do have a buyer who's a first-time home buyer, have them complete this course. I had my son complete it, whether he needed it or not, because I wanted him to understand the mortgage process. I'm here for him, but I didn't want to receive a call every 5 minutes. So I recommend that you use this and you share this with your network. If you want, this is Rita, to the question that you asked, where do we find all this research, some of these trends and some of the data? We actually have what we call affordable lending insights. If you go to the Freddie Mac page, you'll go to single family, and in there it will say real estate professionals working with us. If you click on that, it's going to take you to a plethora of information that's available, including marketing flyers that can be customized. So you can actually download a Home Possible FAQ or first-time home buyer and actually put your name, your DBA, your contact information, and you can print them. You can have them at your open houses. You can put them in your buyer packets, or you can just share them on social media. There are also some digital assets that you can share on your social media, LinkedIn, Facebook, Twitter, directly from the Freddie Mac website. If you want to keep informed of other maybe opportunities to engage with Freddie Mac, whether it's learning or maybe a new white paper, a new trend, all you need to do is join us. And actually, we use the word subscribe. I don't like that word because you're not subscribing to anything. It's basically you're signing up to receive information directly from Freddie Mac. So let's see, this is the Freddie Mac. That's it. I think, Rita, I've come to the end. So if we have any questions, I'm glad to entertain them now. I'll take a look and you can read them out to me, or.
Yeah, let's give everyone a second. It doesn't look like we've got anything in the chat right now. Let's see. Thank you so much. I agree. She did a great job. It's a lot of great information. So.
No, you're welcome. Thank you all for bearing with me with my little cough there. I tried really hard, but it's hard when you're doing all the talking for a little bit.
Well, now that you have to stand up and stay, be able to not have to drink water.
That's part of my training.
All right.
I was telling Rita, I'm training standing up again.
That's right. Yes. And yes, for those of you that joined late, we are going to send the recording as well as the links and the slides. Freddie Mac is graciously supplying all the information to us that we can pass on to you guys. So I think that we're getting to the end. So I'll just say thank you to Carmen and for each of you for attending and just taking this time to help yourself and your clients. It's so important, especially in today's competitive market, to be able to provide access and tools to the consumer to hopefully help them be able to either purchase a home or get into a home. And then, as I mentioned, this is the first in a series of monthly webinars. We're actually going to be laying out the rest of the year on Monday, so we'll have those dates coming very soon. We'll be back next month with another important topic centered around this same concept. We'll notify you. You can go to the education site or the webinar site and see that and register them. Again, they'll always be around the same time, and they'll be free for all our members. So I appreciate all of you for being here. Hope to see you next month, and have a great rest of the week.
Thank you for having us.
Thank you. We did have one question that came in, Carmen. Do you recommend we pay the monthly fee for Credit Smart or just take the free course?
There's no monthly fee for Credit Smart. It is free. It is completely free. Freddie Mac does not charge for the Credit Smart program.
Great. Okay. All right. Yes, we'll be notifying you guys in our marketing portals, all the information, and we'll try to get you guys on a list to notify you when the next one's coming up since you attended the first one. So thanks a lot. Have a great day.
Thank you.
All right. Bye, Carmen. I'll see you later.
See you later. Thank you, Rita.